I was having a conversation with my hairstylist today, and investing came up, and I want to cover it in this video. So, when we think of investing, she was asking, what exactly should I invest in as a young individual? And I said the S&P 500. It essentially is the market benchmark that tracks the performance of the S&P 500. Super low to get in, average return just north of 10%, which is super important. Exchange traded funds, instant diversification. There is no reason you shouldn't be investing as really any age. And I want to run through this with the S&P 500. So when you think of risk, when you think of timelines, when you think of goals, that is really the driving force behind investment portfolios. And the general rule is when you're a younger age, you can take a lot more risk when you are a younger investor. Now, it has been true, and there has been a lot of articles published that as you start as a younger investor and then you start aging, you should keep your portfolio pretty consistent to having and holding a majority of stocks in the portfolio versus switching it up to a lot of bonds. Bonds, unfortunately, do not perform and have really underperformed the market for an incredible amount of time. When you start looking at the 10-year return, even in, let's say, the short-term bonds, they are running about a 2% growth, where the S&P 500 is north of that 10%. So thinking of the young investors, we are thinking of the 20s and 30s, which is exactly where she was, high allocation into stocks. This is where the S&P 500 absolutely could pay off. When you're in your 20s and you're putting money in there, you should have roughly 90% of your portfolio into stocks itself. Now, personally, and the advice that I always give, I do not buy individual companies. Picking individual companies is incredibly difficult, and a lot of people over an extended amount of time can make a lot of money, but on the flip side, they can also lose a lot of money. Even when you start getting into your 40s and 50s, having about 80 to 90% of that stock portfolio still in stocks themselves make a really big difference. Now, when we think long-term focus, going in and investing in something like the VOO or the SPY, very comfortable, very technology driven, because we know they are market weighted cap, meaning out of those large companies, when you think of Apple, Nvidia, Microsoft, Google, are the heavy tech companies, and they are going to hold the bulk of the majority in that S&P index. The buy and hold strategy has proven success record over a long time. Now, I was actually watching a video from the author of The Psychology of Money. Incredibly smart, and really buying and holding for an extended amount of time or an extraordinary amount of time is what is going to create wealth. When you think of investing in the S&P 500, if you're putting constant contributions, consistent contributions in there, let's say $100 a month over a 50-year period, chances are you're going to have around $5 million in the S&P 500 just from investing in one single fund, with the compounding, the dividends, everything you get in there. Now, for me, very similar to 401k plans, I do dollar cost averaging, and I do dollar cost averaging into the S&P 500 every single week. Monday morning, we're putting $250 in the S&P. That is regardless of if it is up, if it is down, if it is sideways, flat, whatever is going on in the market, whatever is on social media, anything you see in the news, I am investing in the S&P 500. Regular investments, the same amount of money, create an incredible game plan. Super effective way for investors to invest in the market without having to time the market. I know I can put money into my S&P 500 funds. I don't have to worry about how it's performing. I don't have to worry about and really have the emotional tie of market swings and seeing the impact of long-term investing. Now, when we start thinking about ups and downs, investing is a roller coaster. What I always tell people when we start with the topic of investing is you have to take a step back. When you think of investing in general, you are looking at a 5+ year time frame. When the market goes down, when the market goes up, in a year, it doesn't matter. In 2 years, 3 years, it doesn't make a difference. We are looking at a 5-year plus time frame for money that is invested. If you don't have that much time frame, it might be CDs, it might be high yield savings. I really wouldn't put it in the market, because like we've seen in like 2022, where it's a 25%, 2022, 25% decrease in the market itself, that could really be too much for a lot of people to stomach. The risk tolerance wouldn't be there. The timeline, the goals would be all thrown off. They'd pull the money out, saying they are not going to be investing anymore. Now, when we start thinking of the mid-career investors, we're looking at 40s and 50s. When you start hitting about 35 to 40, that is the time that a majority of people really start thinking about retirement. And for a lot of us, it is the highest earning years, really the mid career investors, when we start thinking of this is the point where people tighten their belt. They know exactly where they have to be. They come up with a plan for retirement. That should have been done 10 or 15 years ago, but that's okay. Steady contributions are going into the 401k, possibly those IRA accounts, those HSA accounts, and really looking for matching contributions at this point. If you're with an employer, you have to be getting at a very bare minimum matching contributions. But if you're in your 40s, even your 50s, you should be trying to max out or get as close to being that max contribution. What we see traditionally is this is where people start spending a lot more. They get comfortable with what they have and they tone down or they turn down some of those contributions, which is the opposite of what they need to be doing, knowing that retirement is, 10, 15, 20 years right down the timeline. Now, when we look at reallocations, this is something, again, when you start looking at the late 40s, early 50s, getting in towards retirement or getting into those later years, investors should gradually shift assets away from stocks into something more than capital preservation. Now, there again has been a lot of studies that have come out that said if you left the money invested during your retirement years, it would have grown to a point, and really through the compounding, you would have never have to worry about taking money out of there. I know the 4% rule. I know the rule of 100. 4% rule says you can take 4% of your portfolio out while you're during your retirement years and you'll do incredibly well. The rule of 100 says you take 100 minus your age, which right now I am 45 years old. That gives me the number of 65, meaning my stock allocation should be at 65% of my portfolio. For me, I do not agree with this rule at all. I feel like the stock investing, even going through now, even going through retirement, even getting ready for retirement, I am going all in. I'm doing the actually 100% stocks right now. Everything that I have is in the QQQ. We do have the S&P 500. We have the SCHD. We could allocate a little bit more to the SCHD depending on exactly what we have to supplement with Social Security. But I'm going to keep those high growth stocks all the way through retirement. And that's exactly my plan. We are going to have some IRA funds if we do need money there. A majority of all of the IRA funds that we have are in a Roth IRA. But again, keeping and investing in the market, because you have to remember, if you're rebalancing, if you're going ahead and you're adjusting it into something that is a lot more conservative, chances are if you're retiring, let's say 62, 65, if you have another 20, 25 years during retirement where you're going to have to rely on those funds, me personally, I want them growing. I know, the 3 to 5 year time frame or the 5-year greater time frame for investing, but I want those funds growing and I want them growing at a good rate. There's going to be up years, there's going to be down years, but getting the portfolio sizable enough where if we're getting that 10% average return over an extended amount of time, the portfolio is still going to be growing. Now, for a majority of people that are 60 plus, they talk about low risk tolerance. That means taking a lot of money, putting in a high yield savings, looking at a very conservative portfolio. But the S&P 500 can be incredibly diverse and really boost the returns during retirement. Looking at a wider asset allocation framework, which is exactly what we talk about when you think of diversification. You are diversified. You are invested in the 500 largest companies in the United States. When you think percentage-wise, that is roughly 80% of the US economy, which is kind of crazy. Now, also when it comes to retirement needs, the other thing to consider, just like I said earlier, is how much money do you need for retirement? How much do you need on an annual basis? Is the dividend generation going to be enough, like something like the SCHD, which is yielding about that 4% return? If it's giving me 4% in dividends and I'm taking 4%, I never want to touch the principal. I never want to touch the golden goose. I only want to take the eggs or what really the growth is in there, making it and really preserving that nest egg. Now, we're also doing this with HSA accounts. Me personally, I feel like HSA accounts are absolutely underutilized by a majority of people. They might put $2,000 or $3,000 or put into the HSA exactly what they're using during the year, but I feel that is a mistake. As a triple tax advantage account, I am stocking that up and I am maxing it out every single year to the point where I would love to get probably $40,000 to $50,000 in my HSA account, just knowing that it is invested. It is going to grow in that HSA account. And when I do have medical expenses, because I know during retirement, they are going to come, I have the account that is going to be paid, and really knowing that I can take care of those expenses where I don't have to go into the IRA money. I don't have to touch the investment money because I know they are covered. So, all right, guys, so that's going to do it for today's video. Let me know in the comments what you guys think about investing in that S&P 500. And as always, thank you guys for watching.